Hello everyone, today on the final bar, a nice reversal day for the major averages. Optimism for Nvidia and semiconductors pushing the S&P and the NASDAQ higher. 10-year treasury yield makes a new high for 2023. Actually the highest level since 2007. What's next for this key benchmark rate? Finally, we open the final bar mailbag. What is the best way to chart multiple time frames? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to our new live version of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a smoky Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit is really designed for these sort of uncertain times when one week does not feel like the next. We have upswings, downswings, all sorts of uncertainty and competing narratives. What I find is so helpful about technical analysis and charting in general is it really focuses not on what should happen or what could happen, but on the evidence the market is providing back to us. What is happening? And you can focus on signals based on price, trend, momentum, breadth, sentiment, different techniques that we can bring to bear to really try to make sense of things. And overall, fixate on what's working and lean away from what's not working. A lot of movements last week. You had the dollar having an up week and pretty much all other charts that I would look at for the most part having a down week. It was sort of the dollar up and everything else down. Today, a bit of a mean reversion from that retrenchment we've had over the last couple weeks. Technology, communication services actually having a decent update today. What does this mean for the overall market? Is this a short-term brief upswing or the beginning of the end of this great down market that we've had in the last 4 weeks or so? Let's get to the market recap and break down what we saw as analyzing the charts of the day. Before we get to the charts, we want to start with a poll. We always have a poll going on our YouTube channel, of course, on our social media accounts as well. So follow us and subscribe anywhere you can. We asked you recently, which ETF performs best over the next 3 months? 4 choices: oil services, which is the OIH, and really tracks an index called the OSX. Semiconductors, the SMH, banks, the KBE, or gold miners, not physical gold, but gold miners or gold stocks, GDX. 45% of you, almost half of you, said oil services. Tied for second, basically, we had semiconductors and gold miners and banks not getting any love, even though the 10-year yield is making a new high for over a decade this week. I have all 4 of those charts, by the way, set up on our ACP platform. If you're thinking about maybe a little foreshadowing for one of our mailbag questions, if you think about ways to compare different charts, whether at multiple time frames or different stocks in a particular sector, different ETFs, and you're trying to understand the merits of one versus the other, ACP is the place to do that. You basically can create a layout, have multiple charts, and be able to compare and contrast all of them together. It's a really brilliant way of analyzing a group of things, a group of stuff. So right now I have the 4 we selected: oil services in the upper left, semiconductors in the upper right, banks in the lower left, gold miners in the lower right. So first, let's do a basic assessment, because I was taught nothing good happens below the 200-day moving average. So I would say let's immediately remove those 2 that are below the 200-day, which would be banks, which again, even though rates have started to certainly come up, the 10-year yield has pushed above, sort of above 4% plus. Even though you have the yield curve back to steepening, banks are still below the 200-day moving average, a declining 200-day nonetheless. So I'll avoid that one. Gold as well. Gold's been a tough market over the last 3 months or so. Made a new high in April and May. Gold threatening a new all-time high, $2,100 an ounce. We've come back quite a bit from that level. So I'd probably say avoid that for now. That leaves us with semiconductors and oil services. Now, what's interesting is semiconductors kind of top of mind today because the group did particularly well. Nvidia's earnings on Wednesday, maybe the most important market event this week besides Powell's press conference from Jackson Hole on Friday. So overall, I think a lot of eyes on semiconductors. Having a nice up day with the SMH up over 3%. I would go with the Final Bar Nation. I would say oil services. We've talked about the upswing in energy, the upside potential for crude oil prices, the fact that energy has been such an underperforming sector, and when growth stocks struggle, energy can actually do quite well. If you don't believe me, go back to the first half of 2022 and remember what energy did when the major benchmarks, when the growth sectors were struggling big time. Energy was actually having a pretty decent half a year. So I would probably vote for the OIH out of the 4 of these. Again, ACP platform, a really good way on stock charts to sort of compare and contrast, apples to apples basis, a group of ETFs. That's where I'd suggest you look at it. Let's continue on with our market recap. As I mentioned, sort of a nice upswing. Major averages kind of down out of the open, but really pushed higher through the course of the day. The NASDAQ actually finished higher by about 1.6%, dramatically outperforming the S&P, which was up about 0.7%. The Dow actually slightly negative. It was a lot more negative, actually rallied through the afternoon. That puts the S&P right at 4,400. So I'm always keen on those sort of big round numbers, 100 or so as a point to see whether or not we're able to get above or below those key levels. So we closed today right at 4,400. And 4,200, kind of the initial downside target we talked about for the S&P, given the fact that we certainly appear to be in a pullback phase. I don't know if I've seen enough today. I'm sure I haven't seen enough today to declare sort of an all clear from that sell-off. But we'll get to more charts that tell that story a little better than that brief introduction. The NASDAQ moving higher makes the NASDAQ composite right around 13,500. So a nice upswing after last week was just a disastrous week for the NASDAQ, for the NASDAQ 100 especially, and growth leadership names. Mid caps up slightly, and the small cap index, the S&P 600, actually down by 0.4%. Now the VIX was up around 18 on Friday's close. We're back down a little bit, actually a little bit above 17 if I remember right. We're back down a little bit, just above 17. So still pretty elevated relative to where we've been over the last couple of months, but still very low relative to recent history, right? If you look at the last couple years, 17 is a very low reading. And I tend to think of a VIX above 20 as a sort of, generally speaking, volatile environment or an excessive volatility environment. Below 20 means it's sort of lower volatility. So for most of this year, we've been below 20. We've been sort of in a lower volatility environment. Still there, even though the VIX has gone from 13 up to 17, almost 18 here in the last couple weeks. And I think that's certainly still a very important chart to watch. Now, if you look at the chart of the Dow or the S&P, you see this beautiful V-shaped contour to the day. So that is sort of an interesting reversal candle of sorts, right? Markets selling off last week. Today we open, we trade lower, we close back to the highs. That usually makes a hammer candle or some sort of reversal candle because buyers came in around midday and really pushed the price all the way back up. Took away all of those losses from the beginning half of the day and recovered that right back to the zero level. Let's look at some other markets here very quickly. I mentioned in the introduction an upswing for rates. Now that upswing in interest rates has been happening for quite some time. We've talked about how the shorter end of the curve, what we call short-term yields here, usually probably will stay kind of steady. This is really more based on the Fed and the actions that they're taking. That's where they're pushing up and down the shorter end of the curve. That's where banks are lending to each other, and other things tend to happen as well. But that's sort of that end. The longer end is really more driven by market forces and investors buying or selling bonds. It's the auctions that are coming. It's whether people are taking on or reducing risk. All of those things net out to what the longer end of the curve is actually doing. And the 10-year point is so important because a lot of things like mortgage rates tend to be driven off of that point. So the 10-year yield moving higher, making a new high for 2023. And indeed, we're at the highest levels that we've been since 2007. So this is certainly a rising rate environment. I don't think you can describe it anywhere other than that. We had some really good conversations recently about interest rates. I'm thinking of my conversation with Ms. Schneider about rising rates and what that means. My conversation with Tony Dwyer of Canaccord Genuity last week was fantastic. Really knowledgeable expert. Talked a little bit about the absolute level of rates versus the spreads that we've talked about as well, the shape of the yield curve. So if you missed that conversation with Tony Dwyer, make sure you check it out on our YouTube channel. Really well done. Some great thoughts there as well. I would argue that until rates stop going up, they're in an uptrend. That is technical analysis 101, which is understanding and appreciate that markets move in trends. Define the trend and then follow that trend. When I'm looking at the chart of the 10-year, I'm seeing a chart in an uptrend. I'm inclined to follow that until the evidence tells me otherwise. We're almost a full point higher than we were yesterday here, so around 434 at the end of the day. The dollar index down by about 0.1%, so not real much of a change from Friday's close. And last week, again, the dollar was up while everything else was down. Some signs of life here in precious metals. You have gold, the GLD, moving up by about 0.25%, silver up over 2%. Commodities as a whole down slightly because energy prices, particularly crude oil, a little bit lower, but not dramatically lower. Speaking of dramatically lower, I would say I would be concerned if I'm long things like Bitcoin and Ethereum. With full disclosure, I am in a couple accounts, but overall, I would say the short-term story for Bitcoin and Ethereum kind of questionable, and not kind of. We'll look at a chart of Bitcoin here in a moment. You'll see how we've broken down through support. Now we're testing some of the major support levels that we've been focusing on, a key Fibonacci level and also previous lows that we're now testing. Just to finish off, in terms of sector movements, it was the FANG sectors and then everything else today, which again, very contrarian to what we have seen for quite some time now. Tech, consumer discretionary, communication services, your three top sectors. Technology up almost 2% today, followed by the XLY up 1.2%. On the downside, actually over half of the S&P sectors were down, led by real estate, consumer staples, and utilities. And these are, again, three of the most defensive sectors out of the 11 for sure. So sort of offense and particularly growthy offense over defense in today's session in particular. Let's check out a chart of the S&P 500, kind of see what happened and what played out. We've keyed in on this 4,300 level as an initial level after the breakdown of the 50-day moving average, and I think that was an important change of character, what I would like to call. So a change of character for me is the market looks a certain way or a chart looks a certain way, then something's different, right? Something has changed, and the chart doesn't necessarily and usually does not tell you why the change has occurred or really the narrative behind that change, but it tells you something is happening. So for me, we keep making higher highs and higher lows until we don't. We're above an upward sloping 50-day moving average until we're not. And all of those things have happened in the last week, week and a half. Now I think you have to start looking at further downside support. This pink shaded area is around 4,300. That was the August 2022 high. That was a pretty important level here a couple months ago in June as we broke above it and retested it. So I'm keeping an eye on that level as well. I would not be surprised before all is said and done if we were down in this range, this 4,150 to 4,200 range. That's a Fibonacci level. That's a key trend line using the major lows over the last 12 months. And it's also the 200-day moving average right around that level. I wouldn't be surprised if we get down there before all is said and done. But we had a bit of a bounce here. So how do we make sense of that? Well, again, I would think about what happens in the normal cycle of stock trading, right? Remember that stocks don't ever just go straight up or straight down. Elliott wave, which I'm not a big Elliottian by any means, but the philosophy, or I guess the behavioral backings of Elliott wave are this. A market does not go in a straight line. It sort of has a move, what's called an impulse wave, in the direction of the overall trend, then a brief pullback called a corrective wave, which is moving against the trend. And you sort of move in, a big step, 2 steps forward, 1 step back, and that's kind of how a normal trend would play out. And then the opposite on a downtrend, bigger steps down, brief rally to the upside. I would say any bounce here is probably one of those brief rallies to the upside. Now, having said that, we are sort of, I would say, treading water until later this week. Nvidia's earnings on Wednesday could be pivotal because if Nvidia comes up with a very rosy expectation and outlook that says things are great and getting better, semiconductors rally, there's a lot of market cap in there, and certainly the technology space, a lot of things could go higher and push the benchmarks very quickly back to retest the 4,600 level, no doubt. Powell's press conference on Friday. What I think is interesting here is those narratives, I would argue, kind of not complementary. I think they're sort of contradictory, right? Nvidia's earnings may actually be stronger than expected, which could be a bullish sign. I would be surprised if Powell gives anything but sort of measured comments because I think he wants to make sure that it is clear that the Fed can take additional action if they need to. And if you start talking about how things are great and inflation's not an issue, when inflation still is fairly elevated relative to the target that they've talked about, I think that's a dangerous comment to make. So I would imagine those actually end up netting out to a choppy, indecisive market, and that is exactly what this has felt like. So we are getting a bit of a bounce here. A lot of indicators, like the percent above the 50-day, actually getting quite low. So now it's around 1 in 3 S&P stocks still above their 50-day, which means 2/3 of the S&P actually below their 50-day. If you look to the left, previous times we've been down around the 20-30% range. Those have often been buyable dips in a downtrend, in an uptrend. So we could get one of those brief bounces before the next leg lower. And I would say that's the most bullish I could give this market at this point. Is any rally, I think, is probably setting us up for the next move lower as we sort of digest this seasonally weaker part of the year. But I will certainly admit I'm wrong happily when the market does something different, but it's not doing it just yet. I mentioned the 10-year yield, right? A key benchmark, and the absolute level of the yields, as I discussed with Tony Dwyer last week, super important. Yields are going higher, right? The 10-year point for now continues to go higher. It's been going higher actually for about 4 months. If you look back, April was sort of the lowest point we've had in the 10-year over the last 8 or 9 months. From there, we've rotated higher, a downtrend to an uptrend. I would argue we were in a distribution phase or a negative trend, a consolidation phase, and now we're rotating higher, higher highs and higher lows. As long as that pattern continues, making a new swing high, pulling back and making a higher low, which means 10-year yield could pull back and stay above 4%, and that's still continuing this uptrend in rates or a downtrend in bond prices. I think higher rates are another big part of that narrative to be wary of, right? Those higher rates tend to really be a headwind for growth stocks. So you have rates moving higher and growth stocks moving higher today, but if you look over time, if you look at the larger piece of evidence or larger data sets and look at the relationship between rates and growth stocks, higher rates do not tend to be great for growth stocks, tend to be a major league headwind. So higher rates, not great for the growth leadership we've seen rally today, could be just a mean reversion rally before a downtrend continues. I want to go on and talk about a couple other things just briefly. I caught in the news earlier today, Jeremy Grantham and his firm GMO announcing a new quality factor ETF. And I always used to joke with some of my colleagues at a former firm that anytime a new ETF is announced, you don't announce a new ETF when a factor or a theme is getting absolutely crushed. You announce it and you're able to get funding for it when the theme has been working for so long that people are so excited to buy an ETF with that label that they will do. And that usually happens toward the end in the later innings of it. So I'm concerned the fact the quality factor ETF out of this group that I'm showing you, the only one to outperform the S&P 500 year to date, and that is the one that GMO announcing a new factor ETF. So is this the end of the quality factor dominating in 2023? Perhaps, and if you look back at evidence, it's usually not a great sign for that kind of factor when a new ETF is announced. I mentioned Nvidia, of course, semiconductors having a nice up day. Nvidia up almost 8.5% today. This, I would say, still sort of qualifies as a bounce off of an ascending 50-day moving average. We talked at the end of last week how a lot of stocks in the Magnificent Seven, Nvidia included, had broken down through their 50-day moving average. I think the way that this sort of bearish look to the market becomes quickly alleviated is if stocks like this get above their 50-day moving average and stay there. So a big upswing, I think, in anticipation of earnings this week. A lot left to prove, and I think what we hear on Wednesday could certainly provide a catalyst to push Nvidia to new highs, in which case that's a huge tailwind for the broader indexes just because of the size and the implications of that move higher. However, a disappointing earnings on Wednesday could immediately make this a bad dream of sorts, with semiconductors getting some negative news flow and rotating to the downside. Palo Alto Networks, PANW, another one gapping higher today. And again, this is now a common theme with some technology names gapping back above the 50-day moving average. Now, this is a gap pretty significantly to the upside, up almost 15%. Had good news earlier today that the market is taking pretty favorably. Now I'm looking immediately to the left. One of the reasons why this show is called the final bar is because if you want to understand what levels are important, look at the final bar, the current price, and look to the left. You can see we have a lot of overhead resistance here. This is where PANW tops out around 250. We rotate lower. We've gapped higher, but now into this sort of area of overhead resistance. Is there enough upside momentum to not just get to that resistance, but power through it and go even further? I think that is a big question mark. Speaking of gaps, I had to highlight Clorox, one of the worst performing S&P names today. Consumer staples obviously having a tough go of things, but we mentioned gaps a couple times last week. I just want to highlight Clorox as a perfect example of a gap that did not follow through. And as we often say, once there's a gap, what happens immediately afterwards can be very telling. Do you see additional buyers? After the stock gapped higher, $10, $15, do you see additional buyers willing to come in and push it higher? In Clorox's case, no. You actually saw no additional buyers. People were thrilled that that gap higher. They got out, and all of a sudden the price goes back down. Does that the sort of thing that you get with the Palo Alto Networks going through the course of this week? That would be the question for that and other growth names gapping higher today. We're going to continue on with our final bar mailbag. Before we do so, a couple quick announcements. First off, we welcome your questions. Our mailbag is fueled by people like you using technical analysis, using charts, using the Stock Charts platform, and asking us what questions that come up in your normal process of technical work. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on the Twitter @finalbarsctv, and on our YouTube channel, of course, called Stock Charts TV. Just drop a comment right below this video, whatever video you're ever watching. We'll gather those questions, hope to answer yours in our next mailbag segment. I will be doing a webinar coming up tomorrow on Tuesday, August 22nd at 1 p.m. Eastern called The Great Rotation of 2023. This is a free event where we'll talk about some of the technical implications of what we've seen here over the last couple months, the rotation from strength to weakness, the leadership rotation, looking at the relative rotation graphs, the RRG, and a lot more evidence to sort of chart and track and understand this great rotation. Are we done with that rotation, or is there much more to come? Join me tomorrow for this free event where we answer that question together. It's 1 p.m. Eastern tomorrow, the 22nd. Go to marketmisbehavior.com/rotation to sign up for that free event. Also, as one final reminder, we had a great live Q&A on Stock Charts TV's YouTube channel last week on Wednesday. It was a lot of fun. We had so many great questions. Actually, so many, our cup runneth over, and we had an additional mailbag show to sort of answer some of those great questions. So keep them coming and join us for our live Q&A. On the final hour, we often don't have enough time to take a lot of questions, of course, live from the audience. We're trying to get through the charts, but on Wednesday's Q&A session, there is your opportunity. So join us live. If you go to our YouTube channel, of course, you can sign up for notifications so you'll know immediately when we start. That'll be this coming Wednesday, 1 p.m. Eastern, 10 a.m. Pacific on our YouTube channel. Let us open the final bar mailbag, see what kind of questions have come in here in the last couple days over the weekend, and let's get to question number one. Dave, with industrials now in the leading quadrant, is Boeing a good play here? So, of course, and fantastic question. Thank you so much for that. I will start, of course, with my standard disclaimer, not a recommendation, just an observation at most. But I think what you're referring to, I'm looking at the weekly RRG here, and you're noticing how industrials have really rotated stronger. This is on the weekly RRG. The daily RRG, a little different, but kind of gives a similar sort of picture where you see industrials rotating to the upside. Where are we? We're kind of right here. See the industrial sector right there, kind of rotating northeast, and actually you can click there, and you can focus in on it. So what does it mean when industrials are in the leading quadrant, particularly on the weekly chart, right? I would say a lot of those value-oriented or cyclical leadership sectors have rotated stronger and stronger, right? So that tells you, again, the RRG methodology is based on purely on relative strength and some derivatives of that, right? It's looking at how these sectors or whatever ETFs or stocks you put in there, what they're doing relative to the benchmark. We're benchmarking all of these to the S&P 500. So when something rotates from the lagging quadrant to the improving quadrant and then improving to leading, that basically means it's underperforming, but the momentum is starting to improve. All of a sudden, things are getting better and better, and the relative strength picture is really improving. This is actually really starting to outperform. Those tend to be the opportunity areas, right? So in general, I want to be looking for opportunities in things in the improving quadrant, holding things that are in the leading quadrant, taking profits on things in the weakening quadrant, and being underweight or short things in the lagging quadrant. That is my back of the envelope general way of thinking. And again, that's a generalization. That's kind of what I would be looking at. So industrials in the improving quadrant, getting to the leading quadrant, pretty constructive. Now, you asked in particular about Boeing, and again, shout out to a local Seattle company. Thanks for asking about that. I would tell you this. What's interesting about the chart of Boeing to me is what we would call a big base breakout. And this is the line that sort of shows that pattern. And I just wanted you to you key on this area here, right? You had the rally from the October low to the January and February peak, which ended up being sort of the high water mark there. Then you're in this period, right? So I would describe this as an accumulation phase, where you have more buyers than sellers and more demand than supply, obviously demand pushing the price higher, but then we're in sort of this equilibrium phase, right? Anything you can draw a rectangle around, that's what I would call a basing pattern, a consolidation phase. And what that means is basically pretty consistent resistance and support levels, which means we're at an equilibrium. The market is telling you this company's worth around $205, $210 a share, and then we're just over and undershooting that value, right? So it's a market in equilibrium, meaning investors are kind of in agreement as to what this is worth. Then something changes, right? And we gapped higher out of that base. And so when you have what's called a big base breakout, that often indicates a new accumulation phase has begun. Now, what often happens is you get a pullback to the breakout level, and I think that's what we're seeing here. You see the stock rallied up to around 240, pulled back to around 220, which also happens to be the ascending 50-day moving average. This is sort of the classic buy on the dips kind of setup, right? If you look at market history. A strong chart, a breakout above key resistance, a brief pullback, which gets you an opportunity to come in at a lower level. So I think this is a pretty constructive setup as long as we remain above this basing pattern. We get back into this area, then you have to start questioning a little more whether it's sustainable and whether that breakout has now failed and kind of pulled back in. But at this sort of point, I think it's a really interesting setup. And again, the pullback to resistance and the 50-day moving average is what's most compelling about that chart at this point for me. Next question, Dave, how do I create one page with charts using multiple time frames? And thank you so much for that question. It was so awesome that I included it in the pregame announcements about what was to come, because I love this sort of thinking about multiple time frames. And I will tell you right off, the ACP platform is the place to do that. That's our advanced charting platform. I think of I use both the regular Sharp charts, which you're probably familiar with, and ACP. If you watch the content on Stock Charts TV, there's a lot of both that's represented, and certain presenters like who would I say? T.G. Watkins and Joe Rabel and others really focus on the ACP platform. That's the main way that they use stock charts. Others like Tom Boley and Greg Schnell and Grayson Rose use, maybe Grayson's an exception. The first two actually use our Sharp charts. Grayson actually uses both, as do I, because I find that there are times when one is more helpful than the other, more applicable to what I'm trying to do. In ACP, you have the ability to set up layouts. It looks like a little grid, like a little Excel spreadsheet. That's called our layout view. So if you click on that, you'll have some layouts. If you've never used this before and it's kind of blank, go down here to sample layouts and you'll have some options about things that you can do. So you'll see some ones that I created to look at different market trends, things looking at Dow theory and breadth and sector rotation. But I have a couple of views that I like to do to combine them. So this is one that I set up just looking at a candle chart and a daily chart and a weekly chart. I have another one where I'm looking at a bunch of different, I forget which one this is, maybe this one. Yeah, 5 different charts looking a little more at relative strength and focusing on a monthly time frame as well. What's great about ACP is you can have a bunch of these different layouts. You can bring them up and down on command. And then if it's something you want to send to someone else or share on social media, feel free to do that. In the lower left, if you click on share in ACP, you have 2 choices. Share the active chart, whatever the one that's highlighted in green, that's the one you're actively messing around with, or share the entire layout. And then you can actually basically take a snapshot of that whole thing and send a live link as well. So ACP is the way to do that. I find looking at multiple time frames on one page can be so valuable. And if you want more information on that, I think Joe Rabel showed us a really good job of comparing different time frames and showing how you can really bring the ACP platform to life to answer some really good questions using charting on multiple time frames. Great question, by the way, and thank you for that. Next question. Some people say buy when the 10-week EMA is above the 20-week EMA. Those are exponential moving averages that I think you're asking about. And the RSI is above 50. Would you agree? So my short answer is no, I would not blindly agree to that, only because that's not a particular setup that I use. That is not a trading system that I have used or have found particularly valuable, but I'm open to it. So let's bring it up here. 10 weeks, so we're doing 10 and 20. I do have a daily chart, so I'll switch it to a weekly chart here. Let's see how quickly I can use the stock charts platform. All right, so we've got the 10 and the 20 week, and then you also mentioned the RSI above 50. I've got that too. We're going to take off the relative strength. We're going to bring up a little more time, and there we go. All right, so now I've got a 5-year chart of Boeing. I'm just leaving that up here, and you're basically saying when the 10-week EMA, the blue, is above the 20-week EMA, the red, and the RSI is above 50, that's constructive. So I don't have a problem with that. That's not a particular combination that I've used in my own trading process, in my own investing. But I like it, and I will tell you that if you use this, you're going to come to a lot of the same conclusions I am, because the techniques that we're using rhyme. They're not exact, right? They're not duplicates, but they rhyme. And what I mean is they're similar, right? They have a similar idea. I'm looking for charts that are strong in terms of the trend being overall more positive than negative. And I'm looking things with constructive momentum and certainly improvement. Times when that is not happening, but then starts to happen. So look at what happened in Boeing in 2021 and 2022. This whole period, the 10-week EMA below the 20-week EMA. This is actually maybe something I do start to use more, because I kind of like this. Finally, in let's say early November of last year, it gave a quote-unquote buy signal where the 10-week goes above the 20-week and the RSI is now above 50. And what I like about that is it's recognizing what I would call a change of character, right? A distribution phase, a consolidation phase, and an accumulation phase. So no, I don't have a problem with that. I think that's actually a pretty good way of using the weekly chart as a starting point. My market trend model uses a similar combination of exponential moving averages because, just as you found, it can be a pretty helpful way of measuring trend. I also use RSI all the time because I think it's a good way of measuring momentum. So I think the essence of what you're doing is brilliant. That particular combination I've never used until this moment that I can remember, but not too bad. I'll probably dig into this a little bit further. I'm excited for when we have a back testing engine that we can start quantifying these and testing them. In the works. I'll tell you when it's ready for sure. Next question. Can you tell us more about the RRG Relative Strength indicators? I'm wondering if Julius DeKempener, founder of RRG, is getting into our mailbag and populating all these RRG questions. I'm skeptical now. I know that's not true because a lot of people use them and are big fans of them. I'll bring up another stock just to shake it up a little bit here. And you're asking about the RRG indicators. So I actually have a chart style where I'm combining some of these. Here we go. Let's bring up like the XLK, right? The technology sector. So these indicators at the bottom are the indicators that the RRG visualization, right, with the sectors or whatever rotating around the x-axis and y-axis, really the benchmark in the middle. These are the two indicators. So here you can see the indicators in red are the JDK-RS ratio, and if you look to the RRG, you can see that the x-axis is that value, and then you see the other in green is the RS momentum indicator, and that is indeed the y-axis. So these two indicators turned into a scatter plot is basically what makes the RRG look like an RRG. And this is the brilliance of what I think Julius DeKempener did years ago, was come up with a series of calculations to turn relative strength into something that you could then chart as a scatter plot and really show visually the rotation that so many investors have known for decades is the reality of investing. That's what happens to stocks and ETFs in different sectors. Now we just have a way of visualizing it. So the way to think about it, right, if you look at the raw relative strength, this is XLK, just a ratio of XLK versus the SPY, that's the line in black. Look at this red line, which is the RS ratio. Look at how similar they are. They're not exact, they're not the same thing, and that's not what it's doing. It's smoothing it out and using some other proprietary things, but look at how similar the movements in the red RS ratio is versus the pure relative strength. That's why what I often talk about is if the further to the right, the stronger this thing is outperforming, the further to the left, the further it's underperforming. The momentum line in green is kind of a second derivative of that, right? It's looking kind of at the rate of change, but not exactly. It's looking kind of at the momentum of the red line, right? So it's looking at the change in that red line over time, and that's what puts the y-axis here. So literally, if you look at these two green and red lines, you see that they're both below zero. That's going to mean something's in the lagging quadrant at that point because they're both below the zero line. And on the daily RRG, and if I was looking at it currently, you'd see how that actually is starting to rotate lower. So these lines can be really helpful just as an indicator. And again, by putting the red and green lines, the two RRG indicators, you can put on your regular bar chart the indicators that create this visualization. Now, if I confused you completely, and I hope I didn't, click the little magnifying glass, type RRG. You'll get more information about the scatter plot, the RRG graph, and how it's derived, but there's also another article in our chart school pages for free that talk all about those two indicators, how they're calculated, and some best practices of how to interpret some of those different movements. So I would hope you take what I just shared there and follow along on our chart school page. Final question, then we got to wrap the show. Dave, did we really see, quote, blood in the streets during the last bear market? I love that question. This is probably an hour webcast kind of answer that I'd love to give, but I'll keep it to a minute or two. This is referring to a quote by Baron Rothschild, say, buy when there's blood in the streets. And this is a whole sort of argument for contrarians. I think if I'm a true contrarian, that's the kind of quote I have, up on a wall somewhere taped to my monitor. So I'm always remembering my goal is to buy when everyone else is selling and to sell when everyone else is buying. And the implication of that, and this is from hundreds and hundreds of years ago for the record, was basically focusing on when things were so beaten down that you can't imagine buying. That is when you want to start to buy. So looking at the chart of the S&P 500, did we really get blood in the streets? And I think you were referring to the October low of last year, right? Which is sort of, for now, the end of that cycle. That's subjective, right? That's open to interpretation. I would argue, no. I mean, that was not an end of the world kind of scenario. And I've seen a lot of bear markets now over the last 23 years or so, 2001 to 2002, of course, 2008, 2009, the financial crisis. I would tell you there were periods in both of those where you questioned the sustainability of the system. I mean, the questions you would ask were like, is this bank going to survive this thing? And not just a small regional bank, but like the banking system. Is this going? Are we going to be able to get money out when we need it? Type of questions, because things were feeling so ugly. I would argue, no, you definitely didn't get that in October. But what you have to remember is not all market cycles have what we'd call a generational low, right? And a lot of people are referring to that financial crisis in 2008, 2009 as sort of a generational low, similar to what you saw in 1974, right? A period that got so weak that you literally, I mean, figuratively, I guess, saw blood in the streets, but implying that things got so ugly that there was absolutely no reason why you'd want to buy stocks, and that was pretty much the optimal time. I would say that's part of what makes the argument that October 2022 was not the low. It was not the ultimate low that you and I and others will ever see. It was a low, and an important one, but not the low. And remember, most years don't have one of those significant lows. They're actually pretty rare, similar to all-time highs and significant tops. But a good reminder and a good quote to ask about, because it's a reminder to focus on the evidence. What technical pictures can you look at that tell the story of a market completely beaten down? Here's my tip to you, by the way. 10-year rate of change of the S&P 500. That got incredibly low in 1974, incredibly low in 2002, incredibly low in 2009, got nowhere near there in October of 2022. So let's keep it in proper perspective. But folks, we got to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Folks, here is chart number 1. We're looking at the S&P 500. Talk about breadth indicators often on the show. And of course, recently we've been focusing on this rotation from very strong breadth in June and July to now much weaker breadth conditions. This chart, I think better than any other, shows you the change of character that we saw from July to August. Look at the bottom. This is the basically number of new 52-week highs on the New York Stock Exchange in green, and the number of new 52-week highs for the S&P 500 in green on the bottom panel. Look at how in the month of August, all the green has kind of gone away, and now we're starting to see some red. These are stocks in the NYSE and the S&P 500 actually making a new 52-week low, not just breaking the 50-day, not just pulling back a little bit like Nvidia did, but going to a new low for the year, for the last 52 weeks. That is a significant breakdown. The more red and the less green you see on this chart, the less optimistic I feel you should be, because it tells you there's more and more of a washout still being played out. Chart number 2, looking at the home builder space. When I think about what's happened just in the last week or two, I think last week was pivotal because certain groups like home builders have been holding up so well. What often happens when a market phase starts to rotate and things go from optimistic to more pessimistic or more constructive to more destructive is when you see groups that have been holding up all of a sudden fail to do so. I would say it was pretty important last Thursday when the ITB, which is a home constructing ETF, finally broke below its 50-day moving average and for now has stayed there. That also lines up almost perfectly with the trend line connecting the October, April, and May lows. Look at how we broke down through that trend line. Look at how we broke down through the 50-day moving average. I would imagine that there's probably more downside to be had after a breakdown of this magnitude, but I'm going to be patient and watch the chart do it. Right now, we're testing support right around 81, 82, we'll call it, from the July low. Does this hold this week, or do we break down? And if we follow through, I think there could be much further downside for something like home builders. Of course, higher rates not helping the case for home builders. And charts like BLDR, which at one point was one of the top-ranked stocks in our large-cap scooter rankings, now pulling back quite a bit, down 25 points from its high just a couple weeks ago. Final chart for the day, Bitcoin. I mentioned Bitcoin rotating lower. Look at this consolidation phase, and I don't think you can label it as anything different than that. Look at the high in April, how that lines up with the highs in June and July. Look at the low that we saw in June, how that lines up pretty well with the low we've been in at the last couple weeks. 25,000 is an important level. That's the June low. That's the Fibonacci support level that we've tested before and held. If Bitcoin can hold 25K, I think there's certainly a good opportunity to rotate back to the upside and ride this thing higher. But a risk-off move for stocks most likely coincides with further risk-off sort of feel in Bitcoin, and Bitcoin goes sub 25,000. Good place to set an alert on the Stock Charts platform. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. Such a pleasure to be back live with you. Keep with us as we get back to the live mentality, but so far I think we're doing pretty well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.